Hello Canadians, I'm your mentor Bakar Bhatti. In this video, I'm going to explain to you one very important financial statement, and it is the income statement. But before we proceed further, here's the disclaimer that the purpose of this video is only to orientate you about the concept of income statement. Well, if you need any mentoring or coaching in accounting, you may contact us at 289-952-3494, else you can send us an email at pascat2017@gmail.com. Here's the scheme of presentation. As you can see, first of all, we'll look into the purpose of income statement, and then I will explain to you some of the important segments of income statement. And finally, we'll just look at a worked example of income statement to make this concept more clear. Now, what is the purpose of income statement? An income statement is meant to measure a company's operating performance and report net profit or loss for the period. And this we do by matching incomes earned and expenses incurred during an accounting period. So basically, it is an application of matching concept, and the purpose of income statement is to comment on the operating performance of an organization or entity. Now, here are the important segments or components of income statement. It highlights the total revenues generated during a particular accounting period. Then we also calculate the gross margin, also called the gross profit margin. Then we look at income before income taxes. These are basically, this is the income that is net of your operating expenses. Then we look at income taxes, because every organization has to pay taxes, particularly if you're an incorporated business. And then finally, it is the bottom line, that is the net income or profit earned during a particular accounting period or fiscal period. Now, here is the worked example of income statement. If you look at this income statement, this is the first component. And this income statement states that basically it covers the time period from 1st January to 31st December 2016. And all the values are expressed in millions of dollars. For example, revenue or sales is $15454 million, and the cost of producing this revenue, that is the cost that we have incurred, is $9540 million. And the gross margin in this case, that is the difference between revenue, sales, and cost of producing revenue, is 5914. If you look at the percentage column, you'll notice that the gross profit margin is 38.7%, implying that for every dollar we have generated a gross margin of 38.27 cents. Now, we move forward. Here is the other part of the income statement. In this segment, we look at other income or expenses. In this case, it's $15 million of other income that is shown. Then there are selling, general, and administrative expenses that would cover all category of expenses incurred by an organization to run their business, and the value is $4345 million. And then there is the net finance cost. What is the finance cost? We know that companies might have borrowed money and that they have to pay interest cost on it. This is the finance cost. So it is $114 million in this case. And finally, we have income before income taxes. It is the difference between the gross margin, and of course, we add up the 15 million of other income, and then we deduct the selling, general, administrative expenses and net finance cost from this figure, arrive at a figure of 1470. That is 9.5% of our total sales revenue plus other income. And then, of course, as an organization, we have to pay income taxes. That is $338.10 million in this case. And finally, we have the bottom line, that is the net income or profit for the fiscal period. And this figure is $1131.9 million. And this is approximately 7.32% of total revenues generated, including other income. So this is how we determine the performance of an entity in terms of its profitability. For mentoring and coaching of accounting, send us an email at pascat2017@gmail.com or call us at 289-952-3494, or else you can visit our website at www.pascat.com. I hope you enjoyed this video. Thank you.